Stop. Do not let this moment fool you. I know what you are watching right now. Gold is hovering at $5,181. Just beneath the 5,200 threshold, the entire market is staring at like a line drawn in blood. The forums are split, half saying this is the ceiling, half saying the ceiling is already gone. They are both looking at the wrong thing. It is Thursday, February 26, 2026. What matters today is not the price tick. What matters is the reason gold is sitting at 5,181 instead of 4,300. Two separate geopolitical detonations are keeping gold pinned to these historic altitudes. An American trade war that survived the Supreme Court and is now running on borrowed legal time, and a Geneva negotiating table where Iran and the United States cannot even agree on what to discuss. Ladies and gentlemen, Vault Tracker here. This is the most consequential day for gold since January 30. You need to understand what is actually happening. Gold is heating up, and this move could surprise the market. Let's break down what's happening right now. If you want clear and powerful gold market updates, make sure to like, subscribe, and follow Alex Carter Reports for the latest analysis. To understand why 5,200 is the immediate battle line, you need to understand the structural anatomy of the advance that carried gold from its correction low all the way back to 5,181 today. The structure is not fragile. It is one of the most technically sound recoveries any commodity has staged in modern market history. The anchor point of this entire recovery is $4,401.99. The corrective bottom that formed after gold's near $6,000 peak was brutally sold following the war shock. Technical analysts note that the Fibonacci 50% retracement of the full swing from $4,401.99 to $5,597.89 lands at $4,999.94, essentially $5,000. Exactly. This level coincides with the rising 21-day simple moving average position just above $5,020. Two separate technical constructs converging at the same price zone. That is not coincidence. That is a support architecture designed by the market itself. Reports confirm the 21-day and 50-day simple moving averages are both rising. The 100-day and 200-day moving averages are extending higher, confirming the broader uptrend. The RSI sits around 59. Analysts describe this as sustained but not stretched upside momentum following the recent correction consolidation. This is the technical definition of a bull market in healthy recovery. Not parabolic, not exhausted. An RSI of 59 with rising moving averages and a Fibonacci confluence at $5,000 is the structure of an advance that has more room to run. The immediate resistance layer is precise. Analysts confirm gold faces resistance at $5,205 per ounce. A sustained daily close above that level triggers the next advance toward 5,244. Reports from the COMEX futures complex show April gold futures trading near 5,198 on February 26th, just $2 beneath 5,298. On February 26th, just $2 beneath 5,298. As traders trimmed short-term exposure even while spot prices held up. This spread between futures slightly below 5,200 and spot at 5,181 tells you the market is not convinced the level clears today. The Geneva outcome will determine whether it clears tomorrow. The broader target architecture is defined by institutional price calls. Sources note Bank of America maintains a 12-month gold target of $6,000 per ounce, acknowledging investors have slowed the pace of exposure increases and suggesting a period of potentially weaker gold prices into spring, but qualifying that resurgent tariff uncertainty may make the consolidation relatively short-lived. Analysts place key support at $5,052.87 and a resistance ceiling at $5,320.89 for the current advance phase. The critical macro catalyst separating consolidation from the next advance is the January 2026 Personal Consumption Expenditures Report due March 13th. This PCE release carries the inflation gauge that shapes Fed policy expectations, dollar trajectories, and real yield dynamics, all three of which directly price the opportunity cost of holding gold. Until that release reshapes the rate cut narrative, gold will balance three forces simultaneously: structural safe haven demand, resistance near 5,200, and the unresolved Geneva negotiating impasse. The structure says higher. The data catalyst is 13 days away. The geopolitical fuse is burning today. The geopolitical machinery driving gold to $5,181 on February 26th operates on two parallel tracks. Both tracks must be understood to separate the structural gold bid from the speculative one. Track 1. The Tariff Constitutional Crisis. On February 20th, 2026, the United States Supreme Court ruled 6-3 that the International Emergency Economic Powers Act does not grant the President authority to impose tariffs. Reports confirm the majority opinion stated explicitly that the Constitution does not vest any part of the taxing power in the executive branch. The ruling immediately invalidated all tariffs imposed under that statute, including the fentanyl-related duties on Canada, China, and Mexico, and the broader reciprocal tariff regime. Within hours, the White House pivoted to Section 122 of the Trade Act of 1974. Sources confirm this instrument carries a maximum 15% rate and a 150-day expiration clock, expiring July 23, 2026, absent congressional extension. Here is the critical detail gold markets are absorbing on February 26. The 15% rate announced via social media has not yet been formally implemented. Sources confirm the rate currently in force is 10% under the February 24 proclamation. The 15% remains a White House announcement awaiting formal enacting language. This legal limbo, a rate announced but not enacted, built on a statute with a July 23 expiration date, is precisely the kind of policy ambiguity that gold thrives on. Markets must price two scenarios simultaneously: a 15% rate that may never arrive and a 10% rate that may not survive the courts. Analysts note the administration possesses a structural escape valve, allowing tariffs to lapse, declaring a new balance of payments emergency, and restarting the 150-day clock, creating what sources describe as a de facto perpetual tariff instrument that raises serious constitutional separation of powers concerns but remains legally untested. The Peterson Institute calculated the dollar had already depreciated approximately 9% in effective terms since Trump took office. One of the prerequisite conditions, Section 122 invokes for balance of payments justification. Yale Budget Lab analysis indicates Section 122 pushes the effective tariff rate to 13.7%, a net loss of 16% of tariff revenues compared to the full original tariff regime. Tax Foundation estimates the prior IEEPA tariffs added $1,000 in household tax burden in 2025, with another $1,300 projected for 2026 under the replacement regime. Track 2. The Geneva Military Diplomatic Standoff. The third round of indirect nuclear talks between the United States and Iran is underway in Geneva today, February 26. Reports confirm U.S. envoy Steve Witkoff and Trump's son-in-law Jared Kushner are meeting with an Iranian delegation. Secretary of State Marco Rubio stated explicitly Thursday morning that Iranian insistence on not discussing ballistic missiles is a big problem. Iran's position is that negotiations must remain strictly nuclear in scope. Washington's historical requirements include a complete halt to uranium enrichment, cessation of support for regional militia groups, and restrictions on Iran's ballistic missile program. Tehran has proposed a 7-year limit on uranium enrichment. Washington requires comprehensive dismantlement. These positions are structurally incompatible in a single negotiating session. Reports confirm Iran's Supreme Leader Ali Khamenei declared Monday that the United States will never succeed in toppling the Islamic Republic, warning that even the world's strongest military can suffer crippling blows. The United States maintains carrier strike groups and additional naval assets in the regional waters. Iran has been rebuilding nuclear facilities damaged in the June 2025 military strikes targeting Isfahan, Natanz, and Fordow. Satellite imagery shows the Parchin military complex covered with concrete in January 2026, and the Shiraz South missile base undergoing repair as of January 30, 2026. Capital flight from Iran is accelerating as oil revenues decline, per the Central Bank of Iran's own data. This is not a diplomatic environment moving toward resolution. This is a military diplomatic standoff maintaining a persistent risk premium in every market from oil to gold. The sentiment picture around gold on February 26 reveals something specific and historically unusual: a market undergoing institutional recalibration in real time, with retail positions already washed out and systematic allocators cautiously rebuilding. Reports confirm that gold rose approximately 30% in January 2026 alone, a vertical advance driven by geopolitical instability, shifting U.S. economic policies, central bank accumulation, a weakening dollar, a surge in ETF inflows, and a supply-demand mismatch that had been building for years. That advance peaked near $5,608 on January 30th. The war shock corrected the market sharply, the Warsh nomination eased concerns about Fed independence, and the greenback saw some recovery, producing a 26% drawdown from peak to the $4,400 corrective low. The FOMO trade, the leverage, and the tourists were simultaneously purged. What the ETF data shows in the wake of that purge tells the institutional story precisely. Reports confirm ETF flows returned to positive territory following the deleveraging. But the magnitude of inflows for the week ending February 13, 14.8 tons, remained well below the average weekly inflow recorded in January of 27.1 tons. This is the re-entry signature of institutional capital: deliberate, measured, not euphoric. The retail crowd was running into gold at 27.1 tons per week in January. The institutional capital is rebuilding at 14.8. That gap will close. The question is whether it closes below 5,200 or above. Sources confirm China added 40,000 troy ounces to its reserves in January 2026, extending 15 consecutive months of central bank buying. Poland raised its gold reserve ceiling in the same period. These purchases are not driven by price signals from short-term traders. They are driven by the strategic recognition that gold is a neutral, sanction-resistant asset held outside the control of any single foreign government. A calculus that was permanently hardened when Russian reserves were frozen in 2022 and is only intensified as the tariff constitutional crisis deepens the unpredictability of U.S. economic policy. The full 2025 demand infrastructure confirms why the structural bid does not vanish in corrections. Reports confirm total global gold demand reached 5,002 tons in 2025. Total demand value surged 45% to $555 billion. Investment demand alone reached 2,175 tons. Gold ETF inflows of 801 tons, and bar and coin demand of 1,374 tons, represented the broadest geographic participation base in gold's modern history. India's ETFs nearly matched the prior 5-year total in a single year. Even when gold prices fell sharply during a major market plunge, North American ETF funds added $334 million, demonstrating that the institutional allocation to gold has hardened into a structural commitment, not a speculative position. The February 26th sentiment composite is this: retail positioning has been reduced and shaken. The speculative excess from January has been largely cleared. ETF allocators are rebuilding at a measured pace below the January average. Central bank structural demand continues uninterrupted at 15 consecutive months in China. The geopolitical risk premium from Geneva talks without resolution, Section 122 tariffs without formal 15% enactment, and Rubio's explicit ballistic missiles objection remains embedded. Analysts note that Carlo Alberto de Casa of Swiss, quote, identified the combination of Iran-US persisting tensions and uncertainty surrounding the global economy with Trump's tariffs as a bullish catalyst in live Thursday, February 26th commentary. That combination has not changed. It has intensified. Here is the complete bear case for gold retreating from 5,200. Every pillar presented honestly, then dismantled with data. The bear argument stands on 3 columns. First, the Warsh monetary tightening column. Warsh's nomination signals a hawkish Federal Reserve pivot. Reports confirm the market explicitly viewed Warsh as an inflation hawk who favors a smaller Fed balance sheet. This perception was sufficient to trigger a 26% gold correction in days from near 6,000 to 4,400. Higher interest rates under a confirmed hawkish Fed raise the opportunity cost of holding non-yielding gold. A stabilized or strengthening dollar suppresses gold prices denominated in dollars. If Warsh is confirmed and his hawkish policy begins transmitting into rate decisions by mid-2026, the debasement narrative that powered the primary advance loses structural support. Second, the Geneva resolution column. The third round of Geneva talks may produce a preliminary framework on enrichment procedures and sanction scope, even without resolving ballistic missiles. Any signal of diplomatic progress reduces the Middle East risk premium that has been embedded in gold since the June 2025 military strikes on Iranian nuclear facilities. Oil prices already eased on Thursday on Geneva optimism. Analysts confirmed the two-sided setup where signs of progress can also reduce some of the urgency to own defensive assets. A diplomatic weekend headline from Geneva sends gold directly to the 5,052 support test. Third, the Section 122 expiration column. The 150-day clock expires July 23rd. Sources confirm Congress extending them appears extremely unlikely. If the tariffs lapse either through expiration or legal challenge and the administration cannot successfully restart the clock, the inflationary uncertainty bid in gold deflates. A less inflationary environment with a hawkish Fed removes both primary engines of the gold advance simultaneously, the counter to each column. Warsh's first policy decision is in mid-June at the earliest. Markets currently price 3 rate cuts from the Fed in 2026, none of which are being removed by Warsh commentary yet. And sources confirm that Warsh should be considered a pragmatist, not an ideological hawk in the tradition of the independent conservative central banker. The correction from near 6,000 to 4,400 was the market pricing the worst-case hawkish scenario instantly. From 4,400, with gold now at 5,181, the market has already repriced the Warsh overshoot. The next Warsh data point is the March 13th PCE print, not a rate decision. The Geneva counter. Rubio's Thursday morning ballistic missiles statement is not diplomatic ambiguity. It is an explicit red line stated by the Secretary of State before the delegation sat down. Iran's supreme leader declared the U.S. cannot topple the Islamic Republic. Tehran is preparing written proposals, not concessions. Sources confirm the U.S. historically requires comprehensive dismantlement, while Tehran proposes time-limited restrictions. This gap does not close in a single Geneva session. The risk premium stays. The Section 122 counter. Sources confirm the administration could allow tariffs to lapse, declare a new balance of payments emergency, and restart the clock, creating a perpetual tariff instrument through repeated declaration cycles. Section 301 investigations for future permanent tariff authority are underway. Section 232 duties on steel, aluminum, copper, automobiles, and auto parts remain fully intact, unaffected by the IEEPA ruling. The tariff architecture does not disappear on July 23. It transforms into a new legal form, and each transformation restarts the market's uncertainty pricing that keeps gold elevated. Against these three time-limited, event-dependent bare pillars stands a 5,002-ton annual demand base, 15 consecutive months of Chinese central bank buying, and 27.1 tons of average weekly ETF inflows in January, none of which expire in July. The structural bid outlasts the bears' event-driven arguments every single time. The battle plan for gold on February 26, 2026. Gold at $5,181. 5,200 under siege. The map. Level 1, $5,000. The psychological anchor and structural defense line. Reports confirm this level coincides with the Fibonacci 50% retracement of the full January-February swing and the rising 21-day simple moving average just above 5,020. This is not just a round number. It is the convergence point of two independent technical constructs that both point to the same price. A Geneva breakthrough producing a preliminary framework would likely test this zone as safe haven demand deflates temporarily. The coiled spring is loaded between 5,000 and 5,181. A test of 5,000 is not a disaster. It is the accumulation zone. Level 2, $5,052.87. The immediate support identified by analysts as the first meaningful structural defense below the current price zone. Reports place this as the key floor that must hold on a daily closing basis for the bull structure to remain intact. An intraday dip below 5,052 that recovers to close above it is a signal. A daily close below it is a warning that tests 5,000 directly. Level 3, 5,181 to 5,190. The February 26th equilibrium zone. Spot gold at 5,190 on Thursday morning and April futures at 5,198, both sitting just beneath 5,200, balancing the two opposing forces of geopolitical risk premium and diplomatic hope. Every session that closes in this range confirms the market is in wait-and-see posture, holding position until Geneva resolves. Level 4, $5,205. The resistance breakthrough trigger. Analysts confirm this is the key resistance level. A daily close above 5,205 activates the advance toward 5,244. Reports confirm that if Geneva negotiations break down, a surge in safe haven demand could easily propel gold past the 5,200 mark. The binary catalyst is the Geneva outcome. A stalemate announcement, citing the ballistic missiles impasse, is the switch that clears 5,205 within 24 hours. Level 5, $5,320.89 to $6,000. The institutional target range. Analysts place $5,320.89 as the upper resistance ceiling for the current advance phase. Bank of America maintains $6,000 as the 12-month target. Sources confirm that if the Section 122 constitutional crisis deepens with a fresh legal challenge, gold could test 6,000 as the ultimate insurance policy. Scenario 1: Geneva collapses. Thursday's third round concludes without progress. Rubio's ballistic missiles objection becomes the formal sticking point in the joint statement, or no joint statement is issued. Iran's written proposal is rejected as insufficient. Gold breaks above 5,205 in Asian trading Friday. The formal 15% tariff proclamation drops concurrently. Gold advances toward 5,244 and toward 5,300. Diamond hands who accumulate 5,052 to 5,181 capture the full advance. Scenario 2: Thin diplomatic progress. A narrow technical agreement on enrichment procedures is reached without resolving ballistic missiles or full sanction scope. Gold tests 5,052 briefly on the relief response. The structural bid, central bank buying, PCE March 13th data. Continued tariff uncertainty absorbs the dip and rebuilds above 5,181 within days. The path to 5,205 remains open before March 13th. Your question for the comments: with Geneva talks hanging by a thread over ballistic missiles and Trump's 15% tariff not yet formally enacted, Do you believe gold breaks 5,200 before the March 13th PCE data, or does a diplomatic surprise first create the 5,052 accumulation opportunity? State your level in the comments. This is Vault Tracker here. The constitutional clock is ticking. The diplomatic table is fracturing. StackNow. That quotes it for today's silver update. The market is setting up for a potential big move, so stay alert and stay prepared. If you found this analysis helpful, don't forget to like the video, subscribe to the channel, and turn on notifications so you never miss an update. This is Alex Carter Reports, bringing you clarity in every market move. See you in the next one.